Wow, what a beautiful and comfortable place. Dr. Lambu, what are you going to teach me today?
We are going to learn about some jargon you will experience in Forex trading. Pip and spread. A pip is the smallest unit of the price movement of a currency pair. For instance, if the price of US dollar to Japanese yen rises from 109.94 to 109.95, the price movement represents 1 pip. In the Forex market, a spread is the gap between a currency pair's bid price and the ask price. If you buy a certain currency pair at its bid price and sell that immediately at the ask price, the incurred loss is the spread. Open position and close position. An open position is an established or entered trade that is yet to be exited. On the other hand, closing a position refers to the execution of a transaction that is the exact opposite of an open position. Take profit and stop-loss orders. A stop-loss order is an order placed to exit a trade. When the price reaches a certain predetermined price, it is designed to limit an investor's loss on a position based on their risk-to-reward ratio. On the other hand, a take-profit order is a type of limit order that specifies the exact price at which to close out an open position for a profit. Take profit and stop loss are two important tools of trade management. In this lesson, we've learned 3 common terms in Forex trading: pip and spread, open position and closed position, take profit orders and stop loss orders. Well, now I have a quiz for you. That is all we've learned today. In the next video, we are going to learn about the rollover rate.